In this episode, I'm going to reveal the actual IUL performance for the 12-month period ending March of the year 2025. So get ready. In this episode, I'm going to show you various results of 20.51, 9.48, 8, 14.62, 33.83, 17.78, 26.26, 23.09, and again, 20.25, 20.6. These are actual IUL policies, actual rates of return. Get ready. I'm going to go deep into every single one of these. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for north of 5 decades, helping thousands of Americans optimize their assets, minimize taxes, and empower their authentic wealth. My favorite financial vehicle, without question, is a properly structured, max-funded, indexed universal life. When it's structured correctly and funded properly, it is deemed a L.A.S.E.R Fund. L.A.S.E.R is an acronym that stands for Liquid Asset Safely Earning Returns. Now, as I mentioned, I have a lot of critics out there that don't believe that IUL performs very well, and I just snicker and roll my eyes. So every month, I am going through a dozen or so actual IUL policies that month received credits for the previous year or maybe 2-year period ending in March of 2025. So let's go into each of these and I'll show you some examples of this. Now, in this particular case, of course, you don't see the client's name because that's confidential. This is an actual snapshot or picture of their statement. So this client is diversifying between a 1-year indexed, a 1-year high cap index, and a 1-year high par. Okay. If your IUL advisor is not diversifying your IUL policy, you may want to consider getting a different IUL specialist or getting them trained. Okay. So this client had $484,000 put into the 1-year index, and for the previous year got 8%. But they were using what is called a multiplier. Basically, that means they told the insurance company, you can use the interest on our money to fund an options budget, but we're going to let you use even more, maybe 5 or 6% of our cash value, the interest on our money. You can use 5 or 6% of our cash value to fund more options, but that's the most we want to lose. Okay, we want to cap what we would lose at the most if we guess wrong and the economy tanks. So the most they would lose would be 5 or 7.5%. Okay. But the upside goes up dramatically because the insurance company will pay you 2.7 times whatever the index did. Okay. So this client got 8%. That's $38,000, but they get 2.7 times that, which is $104,000. So they made $104,000 on $484,000 that's in this policy. They had another $494,000 in this policy that earned 9.48. That was a 1-year high cap. 9.48, that's $46,900 times 2.4. That multiplier is times 2.4, 2.43 to be exact. And that's $114,000. And then on the 1-year high par index, they had $500,000 of cash value. That earned 6.25. And that's 31,000 times 2.7. They made 85,000 there. So look what happened. Okay. They ended up making $304,000 on that policy during that one single year, which is a 20.5% 1-year return, tax-free on their IUL. We do this all the time. Okay. Here's another one. This one was the 1-year high cap. This is very simple. They had $53,700. It got credited 9.48. Okay. And they didn't do a multiplier. They're very, very conservative. Okay. And so they didn't want to even lose 5%. So they settled and they made a rate of return of 9.48. Just very cut and dried, which is $5,000. 9.48, not a bad rate of return, especially when it's tax free. Here's another one that didn't do a multiplier. They just got 1 times whatever it was. They got 9.48 on $4,200, 6.69 on $4,100, 7.43 on $4,100. Okay, and so you average those and they got 8% return tax free. This is a no-brainer. You can't believe how many IUL policies that I don't even see a rate of return of 2 or 3% because they're structured wrong. Okay. Now here's another one. 36,000 got 8%, 38,000 got 9.48, 35,000 got 6.25, and they did a multiplier, which was they didn't want to lose any more than a couple of percent, so it was timed by 1.9, 1.7, and 1.9. So they got credited 5,500, 6,300, 4,200, and these rates of return with a multiplier ended up being 14.62. Yeah, they didn't earn 20 like some of the others did, but they earned 14.62, and it was very conservative in that approach. It's based upon your risk tolerance. How much can you afford to lose? Can you afford to lose 5% that year? Well, those people came out quite a bit ahead because the reward was they had to incur some risk, but it was worth it. These they didn't want to incur that much risk, but they got 14.62 instead of 8. Does that make sense? They're all good rates of return. This client, they did a 2.4 and a 2.7 multiplier. They got 9.48 and 17 times 2.4 and 2.7. They averaged 33.83% on this policy. At the end of the year, they had made $255,000 in tax-free return on this policy one single year. Okay. Here's another one, 8% and 9.48 and 6.25 times just 1.7, 1.6, 1.7. And so you add all those up and they average 17.78% rate of return on their money, but it was diversified, 2,700 in one, 2,700 in another, and 2,100 in another. See, some of these policies only have about 10,000 of cash values. Others have 100, 200 grand, a million, 10 million, okay? This client, very simple. They got 17% return because they were in the 2-year. You wait 2 years, but the chance that the market was going to be up over 2 years was very great. They got 17%, and they multiplied that by 1.5 because they were willing to lose a little bit to let the insurance company use a little bit more of their money. And so they ended up with a 26.26% return in over the 2-year period, okay? Not bad. Not bad at all. Here's another one, 9.48 times 2.4, that's 23.09, okay? That's a 1 year. That's a 1 year high cap index. Here's another one, 23.09, that's 18,000, 9.48 times 2.4. Here's another one, 79,200 bucks got credited 8% times 2.7 is 17 grand. 53,000 got credited 9.48 times 2.4 is 12,300. 82,000 got credited 6.25 times 2.7, 13,000. You add all of those up, $43,000 is what they made tax-free, 20.25% rate of return. These are actual IUL policies I'm showing you, okay? These aren't fabricated. Here's another one, 20.6. Here the statement went to the next page. And so we have 22,000 got 8% times 2.7, 23,000 got 9.48 times 2.4, and 22,000 got 6.25 times 2.7. So they were credited this actual money, 26,000, 28,000, 25,000. You average the rate of return and it's 20.6. You diversify and you rebalance and you use these strategies. These are called multiplier strategies or maybe threshold strategies. If your IUL specialist doesn't understand this, or if you're an IUL agent and you don't understand what I'm doing here, you're missing out. You're not doing a service for your clients, okay? Here's another one. This policy got 2.81% because it was in the Bloomberg U.S. Dynamic Balance Index, okay, 2.81. And they have 82,000 that got 8.81, okay? So 2.81, 8.81, you know, not bad, but it's way better than most of the IUL policies I see out there that are not structured correctly. If this is intriguing you, folks, we have dozens and dozens of IUL policies when they're structured correctly and funded properly that achieve those rates of return. So if you want to learn more about what I'm talking about, you need to study the L.A.S.E.R Fund, or if you're an IUL agent, you need to engage with IULinsiders.com. IULinsiders.com, okay? If you're a member of the general public and you want to learn about this, I would first recommend you study my book, The L.A.S.E.R Fund, okay? Now, it's actually 2 books in one. The white covered side is about 200 pages. 14 chapters with all the charts and graphs and explanations if you're a left brain learner. If you're more of a right brain learner, you learn more by stories. Flip it over to this one. This is about 100 pages, 12 chapters with 62 actual client stories. If you want to use your left brain and your right brain, you can read both of these, the whole book. But when you gain insights by studying the book, and when you're in there claiming a free copy, now you can buy it on Amazon for $20 up to $60 plus shipping. If you do that, thank you. Okay, it's been a top seller on Amazon, but I'll gift you a copy free. Okay, simply go to L.A.S.E.R Fund.com or click on the link below. But I require a little skin in the game. You contribute a nominal amount towards the shipping and handling. I'll cover the rest of that and I'll pay for the book. I will fire out a hard copy to you via priority mail. And when you're in there claiming your free copy, if you like to listen and learn or watch and learn, there's those formats available for your investment. You can even schedule for a free educational webinar we teach on a weekly basis. No cost, no obligation. But if I were you, I would also schedule an appointment while you're claiming your free copy with a trained IUL specialist, a certified individual that I oversee that can show you an actual illustration of an IUL structured correctly and funded properly. No cost, no obligation, so you can see how one structured right performs in your particular set of circumstances, okay? It's imperative that you have it done correctly. You don't go to just any insurance agent if they have not been trained. And if you're an IUL agent and you do not know how to do what I've been talking about here, you better check out IUL Insiders and learn how to do the best job for your clients.